Welcome to the Financial Update with First Community Bank, live every fourth Thursday of the month on WLIJ and podcasted on Facebook. Join guests from First Community Bank and our host as they inform, educate, and encourage you on all things finances. First Community Bank is a member FDIC, equal housing lender. Now, here's your host. Well, good morning to you. This is Chase Clanton with Hopkins Farms Broadcasting. Proud to present you the financial update with First Community Bank. I'm joined today by their CEO, Scott Kokenauer, and their president and CFO, Daniel Watson.
Morning.
Good morning.
Good morning, Chase.
Scott,
good morning, all.
Yes, sir. Everybody listening out there and watching on Facebook. How you guys doing today?
Doing good. Doing well, thank you.
Excellent. Yeah. I'm beginning to learn watching the cicadas fly around, so.
You're beginning to learn. What are you learning from them, Scott?
This is just flap harder.
Flap harder. Keep going. There's a lesson in that for all of us, I guess. But that's funny. But today, we're going to be talking about all things finances, of course, with First Community Bank. And our topics today are a housing market update and some interest rates and maybe some other things if we get to them. But let's go ahead and jump in, guys.
Let's do it.
Talking about interest rates, how do banks determine the interest rates that they offer on savings accounts, CDs, deposit products, and other things like that?
Well, I want to take that one step further back, Chase, and pardon me for getting maybe too technical or too deep in the conversation. Interest rates are something that are used to drive business or encourage people to hold funds. The Federal Open Market Committee, the FOMC, which meets on a regular basis, that works on stabilizing employment and our inflation, uses it as one of their tools to encourage people to spend or encourage people to save. And it helps drive rates basically across the board, whether it's in the banking world, whether it's in the securities markets, whether it's whatever those things are. So it is a fairly large piece of what goes on there. Trying to slow inflation down, which has been pretty high over the last several years. Mm-hmm. They've raised rates there to encourage people to save and not spend and to slow the inflation down. So that is a big piece of what drives nationwide rates. When you start looking into more local rates, I don't think we have a whole lot of banks in our area, financial institutions in our area that use specifically the Fed's rate numbers to price things, but I know that there are loans that are tied to a prime or to discount rates or otherwise, so those do get transferred there. But the other pieces of that, CD rates, savings rates, and otherwise, do move somewhat along with the rates that the Fed set.
Yeah, I think it's not entirely a free market in that sense. I'm not an economist, so I may not be using that term correctly necessarily, but the government, the Federal Open Markets Committee, the Federal Reserve, they set these targets rates, they move, and then financial institutions react. Now, at that point, there is I think the market comes into play, and we compete with each other, and so, if bank credit unions want it, now even insurance companies online and other online places, if they want to raise funds, for a bank it'd be deposits. They may put out a rate to attract customers, like Scott was saying, but those are all going to be kind of pivoting around a reference to what the FOMC, the Federal Reserve, what they have targeted the rates should be. And then kind of from there, we will compete with each other for customers' deposit business.
I see, yeah.
Yeah, that's the try not to get too down in the weeds on that. My accounting side will come out, but we're the middleman. Like we exchange money, right? A bank will borrow money from you in the form of a deposit to lend out to another customer in the form of a loan. we all live on the spread, the difference between what we're paying a depositor and what we're able to receive from a borrower.
Right.
And so we kind of price, we'll all price accordingly on both sides of that transaction. But for folks just watching the news and wondering what rates may do, the comments from the Federal Open Markets Committee, that's a big indicator of where things are going to head.
Yeah, and I think people are aware that, like the Federal Reserve's interest rate affects you personally, but how does it trickle down and get down to those people? I know the banks react to that, but maybe what really is the Federal Reserve, really, without being like a conspiracy theorist or something?
That's another question.
Okay,
That's a big question, I know.
Thank God we have a 3-hour show. The Fed has several different divisions in it. One of them is a regulatory division, which regulates banks, much like the FDIC or the Tennessee Department or other state department and financial institutions. So they have the regulatory wing, but the responsibility of the Federal Open Market Committee is to do that, is to stabilize or keep an eye on employment, to keep people employed as best they can, and to do things that help that. One of those things they do there is they use interest rates to control the flow of money.
Okay.
By having lower rates, people are less likely to put it in savings. They'll spend it because they're just not earning any money. So in the times where they want to slow the economy down or slow inflation down, they raise the rates, which makes it more attractive to hold money, makes it more expensive,
I guess, to
buy things, because whenever you do buy it, it's costing you more in interest to do those things, so it slows down money going in the economy. So their goal is to push all the buttons that they have in order to work with the inflation and to keep the inflation in. They have a target in their mind that's been in their mind for several years, which is 2%. Right now it's running a little north of 3.5%, which is down from 9.1% a couple of years ago. It's down, but that first little drop in the inflation comes pretty quick, and then it takes a lot longer for that to trickle back down to their 2% range. The Fed and the market itself, when I say the market, the New York market, the stock exchange, kind of have this little thing going on right now where the market, in order to encourage people to put money in the market or for their desire to have, would love for rates to move down faster because it makes people spend and do things to help the market. The Fed, on the other hand's objective is not to work the market. Their deal is to make sure that inflation's in check, and they're in what they're calling a higher for longer rate cycle. Higher for longer is not defined whether longer is 2 weeks, 2 months, 2 years, but what they're waiting on is to see that what's happening with inflation gets down closer to the 2% range before I think they'll move. Every economist you have, every person in the market is going to give you a different indication of where rates will move and how fast they'll move. And most of them, you could take an 8 ball and have about as good an answer as what they have there, because it's dependent on consumer spending and the things in the market that are driving the inflation and when those things slow down.
Right.
Yeah, it's probably, I'm sure a lot of our listeners, have opinions and are educated about the Federal Reserve and the monetary system. For me, it's just my thoughts and observations. The Fed has a really tough job. Because I feel like they've been tasked with kind of being the pressure valve on the economy.
I was going to make a water comparison,
But then the Congress and keeps spending money, right? Keeps telling the Treasury to print money, and so if you've been to an economics class, I feel like the first day they say too many dollars chasing too few goods creates a lot of inflation. I think we've seen that in the last 5 years, the response to the pandemic and things like that. And when we've just continued spending, it's been hard. You read the news and it's been hard to get inflation back under control. And so that's
yeah.
you know, when you, as Scott said, you know, you could look at the magic 8 ball and maybe have guys get a chance of predicting what's going to happen. And I think that's probably right, because you know, even this week in the news, you know, the inflation metrics aren't quite what the Fed would like to see. You know, unemployment's still really low, and a lot of the press, the bigger banks, the national banks, the big national banks, have been predicting rate cuts all year. I mean, you go back to
I think I've heard about that
last fall, and even up through the holidays, they were predicting rate cuts starting as early as March, and that hasn't happened.
No.
So they keep pushing it back, and I you know, my magic 8 ball says it may be next year even before we see a rate cut. Who knows? I think as complicating it is, I think this is a presidential election year.
Yeah, it is.
And so, you know, there may be pressure from the executive branch of the government to say, hey, you know, let's cut rates, but it's hard to say. I think what will happen. I personally don't see evidence that maybe rates should be cut just yet.
Okay.
That they might need to stay where they are for a little longer.
Yeah.
But
Chase, I want to make sure I put this in there that Daniel's opinion, my opinion, are not financial advice in any form or fashion. We're not financial advisors. So.
Correct.
Yeah, agreed.
It's our prediction, our thought process, but it is not an indicator for you to go out and make investment advice upon, please.
Right. Yeah,
it's what we read, what we feel like is the most sensible based on the information that's out there.
It's good to have a good legal disclaimer in there, because this is not, you know, this is not legal advice. This is not, definitely not pressure. You should do this or you should not do this. But
you might want to do the opposite of whatever I
don't know about that. Yeah, you're an expert, right? And so I'm learning things from this as well. I'll tell you what, we'll ask one more question before we go to break here. What role does competition among banks play in determining your interest rates?
It's very much a piece of our play there. It's just like every gas station in town has a sign out front that tells you what the price per gallon is. Mm-hmm. And as you drive down the street, though you may have a favorite, or you know, you have to use a certain brand of fuel, you look at that and you make a decision based on that. And so competition within rates there is definitely something that plays into what we do. We try to stay for our customers in the communities we're in, we try to stay on the upper end of those rates. We're not always going to be the highest on those rates. There are times when banks do have to have some funds, and they will run some specials, get those things in, and you have to abide by those. I will say that some of the internet type deposit rates that are out there, some of those pieces of some larger banks, I guess I take pride in the deposits that we have. We loan back out in the communities we're in. It's not going to metropolitan areas on the West Coast or the East Coast or up north or wherever else it is. They're not taking those funds and loaning out somewhere else. So our target is to borrow money from our customers in the form of their deposits, loan back out to people within our community, and to help our community grow.
So to exactly what you said, take the deposits locally and make the loans locally. Folks, we're live here with the financial update with First Community Bank with CEO Scott Kogenauer and CFO Daniel Watson. My name's Chase Clan, hosting the show. We're going to take a short break and be right back.
Ladies and gentlemen, have you been looking for a way to support your local schools and organizations without dipping into your own pockets? Then listen up. Since 2017, First Community Bank has been donating 3 cents for every swipe made on an FCB debit card to teachers, classrooms, sports teams, and organizations of each customer's choice. And get this, those swipes have added up to over $100,000. That's right, $100,000. And it's so easy to get involved. Just use your First Community Bank debit card for everyday purchases and watch the donations roll in. Don't know how to set it up? Give us a call at 931-684-5800 and we'll help you get started. Let's make a difference, one swipe at a time. Member FDIC, Equal Housing Lender.
You're listening to the Financial Update with First Community Bank. Now, back to the show. All right, This is Chase Clanton with Hopkins Farm Broadcasting on WLIJ with the financial update with First Community Bank, live on the radio and also podcasting on Facebook. So thank you, producer Braden. Again, I'm joined with CEO Scott Kokenauer and President and CFO Daniel Watson. We've been talking about interest rates and the Federal Reserve a little bit and getting some opinions, but not official financial advice. Another disclaimer for you. But let's talk a little bit about housing market. Guys, what comes to mind? I mean, I know interest rates affect the housing market.
They do, and it's been proof over the last couple of years. First Community Bank owns First Community Mortgage, so if you need a mortgage, please go out and see those good folks at First Community Mortgage. I'll go ahead and put that plug in.
Perfect.
I'm sure that'll cost me a little extra somewhere down the line, but we'll get that in there. But, you know, over the last 2 years, or let's go back to 2022, where rates were in the 3% range on mortgages, and things were moving pretty good. Everybody's buying houses. The price of houses going up considerably. Bidding wars on houses and otherwise.
Yes.
The Fed, as we just had talked about, had to start raising rates to try to slow inflation down from the 9% it was at otherwise. So those same mortgages that you could get at a 3% rate back in 2022 are now running 7%. Plus or minus a percent. People look at that, and that the house that they could buy in 2022, maybe at a $400,000 or a $350,000 price range, that same payment now may be a $300,000 house on the 350, and somebody looking at a 400 might be a 350. So it's changing the buyer behavior, or the sellers build what they're building or having for sale, and it's slowed price appreciation down. I didn't say it stopped it, but it slowed it down. There still is some increase there, but it has affected who can qualify for the same house just based on interest rates and the payments that would be there. It's also affected rent prices, because if you're not able to buy a house, you got rent, so now all of a sudden you got rent rises, and those things are in play. I had presented at our shareholders meeting back last month a chart of the 30-year fixed-rate mortgages back to 1972. I chose that because that's how far back Bloomberg had reported those numbers.
Wow.
And prior to 2008, the low end of the housing rates was at 7%. We got spoiled from 2008 through 2023 with rates that were below 7% the whole 15-year time frame. They've now blown back up above the 7% range. But if you look back on that time frame, 1972 to today, 7% was the bottom end of the norm.
Yeah. It's still lower than it used to be.
Yeah. Again, not saying that that's the bottom end there, but I think your 5.5% to 8% range is probably going to be closer to what is going to be normal today and going forward, unless there's some catastrophic event that happens that drives rates down below that. Can we jump in there?
Sure. You take a breath. That's all right. I think for me, one of my observations of people I like just observing human behavior, the modern consumer is that we often, I think a lot of us now buy payments. We don't necessarily buy assets. So what I mean by that is like, you may look at a car or a home or a television or a washer and dryer set and say, can I afford the payment?
Yeah.
Much more than what does it cost? Should it cost this much? Can I afford the asset? And that's for me where interest rates really come into play. Higher borrowing costs impact our as consumers, our ability to buy the payment. Because that's what I was saying. That payment, it might almost be double what it was just a short few years ago.
Sure.
And that has an impact on the economy, and that's what we're talking about earlier in the first segment. That's one of the goals of the Fed. They know that when they raise those interest rates, more. It's going to slow down economic activity, but it frustrates a lot of people too, because one of the statistics I've seen recently about the mortgage is that there's something like 80% of the mortgages in the country right now are at 3% or under.
Wow, yeah. People took advantage of that.
And I think we heard it recently that right now over 50% of the home buyers right now are first-time home buyers. And so what that tells me is that younger folks perhaps, or folks that have maybe rented for a while, they're like, I want to own a home, so despite the rates, I'm going to buy one. But folks that have those really attractive mortgage rates and 4%, 3% or less, they may hold on to that for a long time.
Yeah, and I was talking to a guy last night that does home mortgages too, home loans. It's kind of like a golden handcuffs thing, because you might have outgrown that house that you bought in when there was a 3% interest rate.
Yeah.
But you're so attached to that low interest rate that you're going to stay in the homes, which explains why most of the buyers now are first-time home buyers.
Yeah. Well, that's the same piece I said. With where rates have gone, people not moving, what the rest it is, rates on rent have gone up so much that they're beyond where a house payment is, even at the higher interest rates. So people finally have decided to jump off the rent rolls and into a house payment and try to gain some appreciation and again,
and equity.
Maybe betting on a lower rate over the next 24 to 36 months to where they can refinance into a little bit better pricing.
Yeah.
One of our guys the other day brought up the fact that people that do have that 3% mortgage now that have outgrown the house they have or need to move to a different area, whether it's within the same town or community over or whatever, are looking at that house they had where they got that 3% rate on it, and if they're financially able, and I want to make sure I say that, financially able to buy that new home, rather than selling that house with a 3% mortgage, they're renting it because of where rent rolls are. It's not putting that new home on the market out there for sale. Historically, the norm for new home sales has been in the 6 month supply of homes.
What does that mean, the 6 month supply of homes?
So the number of homes that would sell in 6 months.
Then there'll be no more homes available to sell.
I see.
In a normal market, it would take 6 months to sell all those homes.
So if you didn't finish another house in a normal market today, you could go 6 months before all the new homes were sold out.
Kind of like inventory. You got to stop.
It's an inventory of new homes.
And you burn through it, yeah.
Right now, that number's in the 2.5 to 3 month range.
Oh, wow.
So there is a lot more demand in comparison than there is supply.
Okay.
And again, if you're holding and renting your old home because your rates are low enough and you can afford to do that, that home's not coming to market for those that do come in.
Wow.
Which is making that matter worse in the number of homes that are on the market.
Yeah, I see. Yeah. So, that makes a lot of sense. Yeah.
So there's a lot of things in the housing market that I guess I see we still have a long way to run on a good housing market. I think with a slight downturn in rates, it's going to make that housing market a little tighter because there will be some more sales there. But demand is definitely still there for housing.
Of course. Well, and as we start to wrap up here, guys, I'd like to ask, what strategies can home buyers employ to navigate interest rate rise and secure favorable financing terms in this market environment?
I'll put another plug in for our team members at First Community Mortgage.
Wow, cool.
I think finding, obviously we're partial to them, but finding a good advisor who can help you plan for that purchase. Maybe back to what I was saying a little bit before, not just viewing it as buying the payment, but can I buy the house? Yes. Owning a home is expensive. Beyond just the mortgage payment. There's repairs, and if you're a renter, you call the landlord, the owner, and say, "Hey, there's a leak. Can you come fix it?"
It's their burden.
When you're an owner, you're responsible for those things. So trying to educate yourself and gain an understanding of all the costs of ownership, not just the financing cost, but then also working on things like perhaps your credit, your down payment. Things that if you say, well, I might like to buy a house next year in 6 months, go ahead and start talking to a mortgage lender and saying, what do I need to do to make sure that my finances are in order, that I'll be a qualified applicant.
So in other words, don't start talking to one of you guys when I want a house now.
Yeah.
Maybe pay you guys a visit beforehand so you can get prepared and you can build your credit. And yeah,
absolutely.
Focus within your credit on items you have there, maybe to eliminate and get rid of it, as well as savings. I will never exhaust the statement of putting money back every month, regardless of whether you have a planned event today, because eventually, sometime in life, you're going to have a planned event.
Yeah. Maybe one of the topics in the future could be saving strategies, right?
What a concept for a bank. Absolutely. Well, guys, do you have any other points you'd like to make before we close the show?
Sure. Come on down and see us at First Community Bank. We'd love to have you as a customer if you're not already. If you are, come on down and say hello.
Absolutely. Daniel, anything from you?
We're talking about rates and competition. I've always thought, and it's not an original thought, but if all we have is rate, we're not putting ourselves in the best position. We need to have good service as well. So
yes, and relations.
Hopefully, Scott said, we want folks to come see us, and we're committed to providing great service along with we think competitive rates on deposits or loans, either way.
Yes, and First Community Bank is a bank that I've seen be very involved in the community, like we talked about with the organization's background and the people that work there's background too.
Yeah.
You're not just absolutely. I mean, it's not just the name; it's actually a representative of who you are.
Yeah. Thank you for saying that.
Yeah, absolutely. I believe it. Folks, this is Chase Clanton on behalf of Hopkins Farm broadcasting with the financial update on First Community Bank. Thank you to Scott Kogenhauer and Daniel Watson for joining me today. It's been a pleasure.
Chase, thank you.
Thanks, Chase.
Good to see you.
Absolutely. Braden, back to you.